Hello, everyone, and welcome to our annual State of the Markets presentation. This is Cassandra Lehman. I am the president of Beacon Wealth Consultants and also a certified financial planner. We're really happy to have you here with us today and look forward to sharing some important information with you. The first thing I'd like to do is draw your attention to these disclosures so I can keep the regulators and the attorneys happy. Now, the financial world is incredibly complex, and these days we're all being bombarded with all these dramatic headlines and contrasting opinions. So, our goal today is going to be to educate you about some of the factors that we and the expert financial analysts are watching. Of course, it would be impossible for us to cover everything, but we're going to try to touch on the most relevant factors. And as always, past performance provides no guarantee of future results, so we're going to focus on trends that may help guide the decision making process when investing. So here's what we're going to talk about today: what happened in 2016, what factors affected the markets, what's on the horizon, and what do the financial experts forecast for 2017. Let's start right at the beginning. What happened in 2016? Well, at the beginning of 2016, we were coming off a year when all of the major domestic indexes lost a small amount of ground. In January, fears about China's economy were so strong that the Shanghai index dropped 6.9% on the year's first trading day, and the U.S. markets experienced their worst ever start to a year. By February, the markets hit their bottom for the year before rebounding in response to GDP revisions and consumer spending improvements. Growth continued at a relatively solid but certainly not blistering pace before 2016's first major political surprise rocked them on June 23rd: Brexit. Few people expected the Leave group to prevail and the UK to vote in support of exiting the European Union. So, for 4 days, the global markets reacted strongly to this shock before stabilizing once again. But 2016 still had some curveballs in store for us. After one of the most divisive, hotly contested presidential elections in memory, the U.S. experienced two big surprises. Donald Trump won the election, and the markets responded with near glee, launching a rally that would carry us through most of the year's end. Ultimately, the year ended with all major domestic indexes posting sizable gains, far from the doom and gloom that greeted us in January of 2016. Now, despite experiencing a tough start in 2016, many of Wall Street's top analysts were still predicting a positive year for returns. While an average growth of 7.27% for the S&P 500 might have seemed hard to imagine when we shared these predictions with you last year, the S&P actually beat these expectations. In fact, we ended 2016 up 9.5% for the year, and the S&P 500 wasn't the only domestic index that performed well. The Nasdaq gained 7.5%, and the Dow Jones Industrial Average added 13.4%. Now let's take a moment to look at individual sectors within the S&P 500. The first chart shows sector performance for the first half of 2016, and the second chart shows sector performance for the second half of 2016. Do you notice any interesting patterns? For instance, let's look at financials, which was at the bottom for performance during the first half of the year, losing 3.05% in 6 months. Fast forward to the second half of 2016, and financials became the best performing sector in the S&P 500 with 26.65% growth. Information technology was the second worst performer at the beginning of the year and the second best by year's end. Utilities, on the other hand, had the exact opposite experience. It went from being the second best performer through June and the second worst performer from July to December. So, what do these dramatic reversals tell us? Diversification is key, and knee-jerk reactions could cost you dearly when sectors swing this widely. So investing involves risk and loss, including possible loss of principal. No investment strategy can guarantee positive results. So, we've seen that 2016 was quite an eventful year in the world and in the markets. But let's dig deeper into some of the factors that contributed to the market and economic performance last year. In many ways, 2016 was a good year for American workers. We experienced our 75th straight month of job growth. Unemployment dropped to 4.7%, less than half of its peak during the Great Recession. We're finally seeing the labor market tighten and more people return to work and earn more money. And while higher wages can affect corporate profits, they also drive consumer spending, which accounts for more than two-thirds of our GDP. We hear a lot of bad press about US manufacturing, but the reality is different when you look more closely at the data. As you can see from the first chart, manufacturing output is going up. Now, another way to think about manufacturing, as well as oil and gas production, is to consider the economic value they create as compared to global GDPs. If you look at the value of U.S. manufacturing production, it would represent the 10th largest GDP in the world, bigger than India, Canada, and Australia. And U.S. oil and gas would be the 17th largest economy. Now, in some ways, 2016 was a tough year for oil. In February, crude oil bottomed out at $26 a gallon, a fraction of its peak at over $147 a gallon in July of 2008. At its most basic, there was simply too much oil on the market, driving prices down. By the year's end, however, oil completed its biggest annual gain since 2009, thanks in large part to OPEC pledging to cut production in 2017. At the same time, U.S. oil production is improving, while the cost of producing oil drops, and it appears that energy companies are ready to expand what we are producing domestically. In 2016, oil mergers and acquisitions activity more than doubled over 2015. We're still not back up to 2014 levels, but we take this as a good sign that the oil and natural gas industries are primed to grow once again. For years, as U.S. oil and natural gas production has increased, we've been closing the gap between U.S. oil exports and imports. And although the gap may have widened momentarily while oil prices dropped in 2016, we're moving closer to oil independence. In fact, on December 31st, 2015, the Theo T tanker left Texas loaded with what may be the first U.S. crude oil export in more than 40 years. Then in February, the Asia Vision tanker departed with the first cargo of U.S. liquefied natural gas. Now, as we discussed earlier in the presentation, fears about China's economy were largely responsible for the market volatility early in 2016. Add concerns about Brexit, further disruption to the Eurozone, and beyond, and you may start to wonder what's really happening with the global economy. Of course, global growth still has a number of headwinds, and you really must evaluate markets on a case by case basis. But I think this chart does a good job of showing that global growth is picking up. This Purchasing Managers Index is a heat map that measures growth and contraction in manufacturing. Red indicates contraction, while green indicates growth. And if you can scan quickly, you will see that the January 2015 column has more orange and red than December 2016 column. Look deeper and you'll see positive progress for the US, UK, Russia, Taiwan, and even China. In other words, this data shows us that the global growth is picking up rather than threatening to decline. Let's talk about inflationary trends for a moment. Inflation is a general rise in the prices of goods and services, and it's one of the key indicators of economic well being. Though the relationship between inflation and the stock market is complex, generally speaking, stable, modest inflation is better for equities than high or volatile inflation. If you take a look at the box in the middle of the chart, you'll see several acronyms. CPI stands for Consumer Price Index, and the headline CPI is the most popular measure of inflation. The federal government puts out this data and tracks price trends in a large number of goods bought and sold in the United States. The core CPI below it strips out volatile food and fuel prices to focus on long-term inflation trends. You can see that the light blue CPI line jumps around much more than the darker gray core CPI line, and that's because food and energy prices tend to be very volatile in the short run. Though the past doesn't always reflect the future, historically, a sudden run up in prices has often predicted or accompanied a recession. Note the huge inflationary spikes during the 1970s oil crisis and the 1980s recession. As of November 2016, the headline CPI of 1.7% was well below the 50-year average and very close to the Federal Reserve's 2% benchmark. The Fed has a mandate to foster maximum employment and price stability, and they believe a 2% rate can help support accurate financial forecasting and decisions while preventing harmful deflation. Though we're confident that the U.S. economy is on the right track, we know that the stock market doesn't always follow the economy. One major indicator that we like to look at to gauge the economy's health is consumer sentiment, which is essentially a survey that asks regular Americans how they feel about the economy and their financial prospects. It's an important indicator because sentiment has a strong relationship with consumer spending, which drives 2/3 of the economic growth. Sentiment can also tie to market performance, but in more complicated ways than you might expect. While consumer sentiment can be a rational reaction to a strong economy, a high level can also be a sign of irrational investor exuberance when increased to unsustainable levels. Historically, recessions sometimes follow periods of high consumer sentiment. We see those recessionary periods on this chart as vertical shaded areas. Is that always the case? No, we can see it wasn't the case in 1984 or 2004, but it did happen in 2000 and 2007. For 2016, we ended with December's reading reaching a 12-year high. Later in the presentation, we'll show you reasons why consumer sentiment in the markets look fair. But we will keep an eye on consumer sentiment because it can indicate the market could trend downward. So, what does that mean for us? Don't get too caught up in what others are thinking of doing. Be cautious, watchful, and prudent about managing risk, even when the crowd is going the other way. So, what's on the horizon? Well, we've looked at some of the factors that affected market performance in 2016. Now let's examine what headwinds and tailwinds could affect the speed and trajectory of economic growth in the near future. The next year and our new presidential administration bring many questions about what the future may hold. We could find faster growth, better jobs, increased oil production, and more if three factors happen. 1, the stock market performs well. 2, businesses continue to invest in the U.S. And 3, President Trump policies accelerate the economy. In this case, we imagine future headlines touting major accomplishments a few years from now. On the other hand, if some of the potential risks and headwinds we find catch hold of our economy, we might find a very different view 5 years from now. Ultimately, no one can predict the future, and 2017 brings a noteworthy amount of political uncertainty. We believe that to avoid emotional reactions during times like these, we must focus on the fundamentals, look at what's really happening in the economy, and analyze what the data is showing us. Whether real or imagined, headlines are only helpful if we take the time to think critically and look for truth amid the hype. So, if we're facing uncertainty along with positive opportunities, do we have to worry about a 2017 recession? Let's look at a group of indicators that can help ground our predictions in the data. And this slide takes us back to early 2008. And here we see a group of 20 indicators that help forecast what pressures will be acting on the economy and financial markets in the next 3 to 6 months after the report. So green is positive for the economy, and we would call that a tailwind pushing the economic growth along. Yellow is a caution, and red is a headwind that acts as a brake on economic growth. The dotted lines show where the indicator was in a previous report, while the full line shows the current reading. So here we are in January of 2008, about 8 months before Lehman Brothers collapsed in September of 2008. And you can see a fair number of yellow and red indicators, long before the recession actually started. The economic outlook was negative, energy prices were rising, and the housing market was also a red flag. Now, fast forward to December of 2008, and the red emerges on the board. The economy was in serious trouble. The housing market was deep in the red, volatility was high, the global economic outlook was negative, and business spending was dropping. And now let's look at where we were in December of 2016, the most recent update of these indicators. And you see a lot more green on this board. The U.S. economic outlook was strong, consumer confidence was growing, business spending was on the rise, and many more indicators show positive signs. The only red on the board came from, no surprise, political environment. Given the uncertainty about how our new presidential administration will govern and what policies will come to fruition, this concern seems fair, and one for which we will have more answers later this year. The yellow gauges are areas where analysts have some concerns and will continue to watch for developments, especially over the next 3 to 6 months. So we can see that the global economic outlook and geopolitical risk both appear to be improving. Now, the picture isn't perfect, but compared to 2008, I think you can see the difference in our economy's strength and potential. And as we always say, the past can't predict the future, and financial markets don't always act in concert with the economy. However, barring some unexpected economic shocks, we're pretty confident that we won't see a recession this year. Now, the markets have rallied since the presidential election, reaching one record high after another. But are investors too euphoric? Are equities overvalued? Well, when we look at this slide's data, we see that the markets appear to be at fair value. There's a lot going on in this chart, but let's dissect what it's telling us. First of all, P/E ratio means the difference between a company's price per share, or P, and its earnings per share, or E. The higher the P/E ratio, the greater the difference between what investors pay for a stock and what the company actually earns. So a high P/E ratio means that stocks are relatively expensive compared to what they are earning per share. If you look at the middle dotted line on this chart, you'll see that the average P/E ratio is 15.9 times. In other words, over the past 25 years, stocks have averaged a per price share of 15.9 times their earnings per share. In the Great Recession, the P/E ratio was far below the average line, whereas it was high above the average during the dot-com boom. For 2016, we ended at 16.9 times, nominally above the 25-year average, but still well within one standard deviation above average. So this data tells us that we do not appear to be in a bubble, and instead, stocks are currently at fair prices for their earnings. Perhaps one reason for consumers' rising confidence is that their personal finances are improving. The percentage of debt payments people make compared to their disposable personal income has dropped, and the average household net worth has risen. We've seen a rise in serious delinquencies on auto loans and student loans, but total serious delinquencies have dropped significantly in the past several years. Overall, with rising wages, lowering unemployment, and increasing net worth, outcomes are looking up for the average consumer. So, what do the financial experts predict for 2017? After 2016's numerous surprises and ultimate solid performance across domestic indexes, we look forward to seeing what lies ahead in 2017. And as we've discussed, we see many positive signs mixed with some uncertainty and headwinds to pay attention to. So let's look further at what we may experience this year. So as we discussed earlier, inflation is currently at 2.1%. But what is going to happen in 2017? If you look at the chart, you can see that expectations for inflation jumped immediately following the presidential election. If President Trump is able to lower corporate taxes, increase infrastructure spending, and loosen regulations, or even just one or two of these goals, there's a good chance that the economy will speed up and inflation will rise. But even if inflation does rise in 2017, we don't expect it to reach uncomfortable levels, and the Federal Reserve still has a lot of room to adjust interest rates to help control inflation. The Federal Reserve seems to share our view that the economy and inflation may both grow in 2017. After raising interest rates in December of 2016, only the second increase in 10 years, Fed Chairwoman Janet Yellen said, "My colleagues and I are recognizing the considerable progress the economy has made. We expect the economy will continue to perform well." The Fed also said that they may introduce 3 additional interest rate increases in 2017, up from their previous prediction of 2 raises. Ultimately, rising interest rates are a sign that the economy is doing well. But what happens when interest rates rise? Let's take a look at the chart. The green dotted line represents 5% yield on a 10-year Treasury note. If you look at the placement of the tan diamonds, you'll see that they're mostly clustered in the upper left and lower right quadrants. And what this arrangement is showing us is that when rates are below 5%, equities tend to grow with rate increases. But when rates are above 5%, equities tend to decrease in response to rate increases. In other words, considering where we are with rates right now, history shows us that we may be able to expect the markets to rise as rates increase, as long as they stay below 5%. One area of the market that may stumble when inflation and interest rates rise is fixed income. On the last slide, where we saw the correction between rising interest rates and rising stock market, the data also shows that this scenario can cause bond yields to rise too. While on first glance, increasing yields might seem like a positive scenario, yields and price have an inverse relationship. So generally, the more yield a bond provides, the less it is worth. After experiencing years of low interest rates, many investors may be surprised to see that their bonds can lose money. But a changing tide in the economy doesn't mean you have to abandon fixed income, because it's often an important part of a well-balanced, diversified portfolio that provides the income investors need. Instead, you should pay closer attention to what bond risks and opportunities exist and closely watch inflation and interest rates in 2017. We'll also continue to monitor the geopolitical uncertainty that can significantly affect fixed income yields. Now, after the December 2016 meeting, the Fed released its predictions for GDP and unemployment in 2017 and 18. And as you can see, they predict that GDP will continue its steady, moderate growth, and unemployment will drop even further to 4.5%. Data from the Wall Street Journal's survey of economists echoes these predictions. The good news for workers is that if unemployment continues to fall in 2017, then wages should rise in response. As you can see on this chart, where the gray line is unemployment and the blue line is wage growth, the two measures usually inversely relate. So when unemployment goes down, people can expect to earn more for their work. So, given all these other predictions, what are the experts forecasting for domestic equities in 2017? Each year, various media outlets compile the S&P 500 price targets of Wall Street's top analysts. So, let's take a look at what they have to say about the S&P 500 this year. Now, these targets aren't ours, they are what the experts are predicting. So, as you can see, in 2017, estimates cover a 200-point range, from 2,300 from several analysts to 2,500 at RBC, proof that even experts often have differing opinions. But while they give a range of results, one trend is consistent. Each analyst predicted that the S&P 500 will continue to rise in 2017. The average, 2,359, is 4% growth. Decent returns, but less than half of the 9.5% growth the S&P achieved in 2016. Of course, as we stated earlier in the presentation, we're not trying to foretell the future. No one knows for sure what equities will do in 2017, and predictions at this stage are pretty foggy. However, these 12 analyst perspectives show that optimism continues on Wall Street. Now, we've gone over a lot today, but if you remember just one detail from our presentation, I hope it's this: emotions have no place in investing. Over the past 8 years, we've weathered many storms, from the Great Recession to global pandemics to terrorism and beyond. And after all these tests and all the volatility, the market continues to grow and create new opportunities for you. And as you can see on this chart of stock performance since 1980, the average year has a 14.2% difference between its peak and low prices. And that's a big spread, one that we understand can feel quite unsettling in the moment. But even with these intra-year drops, the market has been positive in 28 out of the last 37 years. Last year started terribly, and imagine what would happen if you'd let fear dictate your response rather than logic and professional support. You could have missed out on opportunities to grow your wealth and pursue the future you desire. We expect 2017 to bring an improving economy, but there's also real potential for volatility. So if you ever feel concerned or want to understand what's happening, lean on us for support. We're here for you. We want to help you make the most of your financial life. So, what can you do in 2017 to move toward your family's goals? Here are some action items for you. If something changes in your life or personal situation, keep us in the loop. We want to hear about important family events like births and deaths, and we also want to know about health issues, employment changes, and any financial developments, such as an inheritance that may change your situation. And if you find yourself thinking about new goals or reevaluating your priorities, please share your thoughts with us so we can help you pursue the life that you most desire. On top of specific financial life adjustments, we also want to know if you experience any changes in your feelings about risk or if you have any concerns about the market environment. We're here to talk you through whatever financial questions, worries, or excitement you may have, so we can help you make informed choices and stay on track towards your goals. And finally, we ask you to go over your estate documents, beneficiary designations, and other paperwork to make sure it's all up to date. A well-organized estate is one of the best gifts you can give your family. Throughout 2017, we'll focus on delivering the following action steps to you. We're going to keep you informed through regular communication. We're going to manage your investments according to your personalized strategy. And we're going to stay on top of changes in the market environment and make prudent adjustments where necessary. Thank you so much for your time today. As you can tell, I'm passionate about helping you understand the markets and find facts amidst all of the hype. So if you need any more information, please contact us at any time. I would encourage you to talk directly with your Beacon Wealth advisor. We hope you enjoyed the information we shared, and if there's anything that you need, please don't hesitate to contact your advisor. God bless.